Good morning, everybody. Welcome. My name is Oliver Crook. I'm Bloomberg Television's Chief European Correspondent. Very pleased to welcome you all here today in Berlin. Today, we will be discussing financing in a multipolar world, strategies for economic security. No shortage of things to talk about. And so I'm very pleased to be introduce the panel that we have today, beginning with Faisal bin Fadhil Alibrahim. He's the Minister of the Economy and Planning for the Kingdom of Saudi Arabia. Daleep Singh is the Vice Chair and Chief Global Economist for PGIM. And Elif Bilgi Zapparoli is the Head of International Client Strategy at Bank of America. Thank you all for joining us to discuss this conversation here. And just as a note for kind of how we're going to proceed here, at the end there will be a little bit of time for Q&A. So if there's anything interesting that you want to return to, note it down, and we'll have a little bit of time to discuss that at the end of the session. So, I mean, strategies for economic security, it's a fairly vast topic for 2025. So just to try to focus our minds a little bit, I'd like to begin by talking about kind of where we are on this trajectory, this new multipolar world, the new sort of economic instruments that are being used across the world, the risks that sort of are carried by that, and also the catalysts. The financial markets have been exuberant. There's been a lot of risk we've been talking about. They're not necessarily priced into the market. So what are the catalysts that could sort of rupture some of these calm that we've seen within the markets? So I'll begin with the Minister. You sat at this table 12 months ago. How has your idea of economic security evolved in those 12 months? It's been very eventful. And how have you adapted the Kingdom strategy?
Thank you very much. It's great to be here again. Maybe I'll start by saying that full multipolarity, we're not there yet. We're on a long transition towards more multipolarity, and in that period, there's a lot of, obviously, volatility, but there's a lot of opportunity. I think the one thing that nations, governments, countries should focus on is solving for their own strength. Strength comes from unlocking your own potential, building the right institutional capabilities, investing in the right areas, but also being better at policy, including impact assessment and agility, and ultimately engaging better with your counterparts, your partners. I think once that is front and center, other things can come into play. For the Kingdom, we focused on, first of all, looking at our long-term impending risks to our economic growth story. There was a dire need, if you extend your investment horizon or time horizon, a dire need for diversification. We don't want to be an economy that is moved by the movement of a single commodity price. And we put a blueprint, Vision 2030, to detach ourselves from that. And it's moving well underway right now. Right now, the reliance on oil, direct and indirect, dropped from the 90s, the low 90s, to 68%. Non-oil growth or non-oil activities today, for the first time, represent 56% of total real GDP, more than government activities, more than oil activities, and more than both of them combined. And we're still getting started. But that came from a direction or a view that we needed to become a stronger, more resilient economy with a sustainable growth story that's productivity-led. And of course, the other pillars are unlocking human capital potential, and there's a lot more that we're still working on. Parallel to that was engaging more meaningfully with our partners, the international community. Because of the flux we're seeing geopolitically, technologically, there are risks and there is volatility, but there's also opportunity. And it depends on the actions governments take, whether they want to accept these risks or do they want to be a shaper, how they evolve and how to navigate this increasingly multipolar world by capturing some of these opportunities. And that's what the Kingdom did. The Kingdom used to be known as an influential player in energy, diplomacy, foreign aid assistance only. Today, that has moved significantly into many sectors and many areas, and today we're global policy shapers with our partners. So not just taking in how the global economy evolves, but being part of the story. And every little voice counts. That's something we learned through our transformation and through our increased global engagement. So security, I think, will evolve in a less uncertain way, the more countries solve for their own strength and the more they engage more meaningfully with their partners or partners to be.
And we see something happening in the United States, which is fairly unique and breaking with the precedent of a great many decades. You obviously were part of the last administration, and thinking about economic leverage, thinking about sanctions, thinking about a lot of the tools that are now being brought to bear in new and unique ways. Where do you see this experiment from the United States leading us, and how the rest of the world is going to respond?
Yeah, thanks, Oliver. Thanks to my colleagues at the desk. I would go back a decade and just observe that around that time it became fairly obvious that the post-Cold War unipolar moment was over. The Republican administration understands this. Democrats understand it as well. Both Russia and China have expressed and revealed a desire to challenge the US-led order. The US and its allies are pushing back. But there's a large and growing number of countries that increasingly want to hedge their bets. They want to carve out a non-aligned path. So the geopolitical backdrop is now much more uncertain. There's much less scope for cross-border cooperation. There's much more likelihood of conflict. And I think because most of today's great powers are nuclear powers, the risk of mutually assured destruction is channeling direct conflict away from the battlefield and into the theater of economics. And that has really meaningful ripple effects. If you look at what's happening within the US, but also other advanced economies, central banks are increasingly price takers from political authorities. Political authorities are ushering in an era of fiscal dominance for defense spending, for industrial policies, which I hope we can speak about. Political authorities are deploying economic weaponry to an unprecedented extent to break bonds in the global economy or to threaten doing so for geopolitical advantage. And then democracies themselves are more polarized than they've been in over a century. And if you have less weight in the political center, you're going to have less centrist economic policy. You're going to have a general disregard of deficits. You're going to have more institutional erosion. You'll have less policy credibility. So it's a very different steady state for the economic cycle, for financial markets, and for how we think about geopolitics.
Elif, maybe I can bring you in here. Maybe you can help me with something, because we've just heard a fairly grim assessment, I think, of the world and the way that it's going, or at least the potential for a lot of risk, right? While at the same time, we say the World War II post-order has sort of devolved, that's over. We see new economic weaponry being deployed. We see, a lot of unknowns around AI and all of these sorts of things, and yet it seems for financial markets, at least the stock market, the party keeps going on. And there was, at the beginning of this administration, an ability to shock the market. You saw sell-offs, you saw things come back down. That has abated somewhat. What are the risks that are built into an unshockable market?
Thank you for that, and it's a pleasure to be here. Thank you for the opportunity. Maybe I start with what are we observing in the capital markets from this multipolarity perspective? Because as His Excellency mentioned, we're not quite fully there yet, but we're on our path, and want to share a few concrete examples of what we're doing, what we're seeing. So let's take an example of Europe, and let's take an institution like EIB. We see a European institution that is very active in the economies, recently updating their taxonomy to also include defense and military. So really being a part of this regional choice, European choice, and being a facilitator of that. Something similar is happening in the US. In addition to everything that Daleep was saying, let's look at the new administration of DFC. DFC, as you know, has got new leadership. I think they were approved by the Senate a few days ago. And the concept of the DFC now is very much an international merchant bank, almost like a private sector style, because everyone that's coming in is coming in from the private sector. And then you go to GCC, especially the Kingdom. What we observe is, of course, the Kingdom and the UAE and others in the GCC have historically been capital exporters. But over the last several years, this has changed. They are now talent importers because of the way they are changing their policies and their focus on the region. We see a lot of people, human talent, and of course the technology and everything that's associated with it move to the Gulf. And when you look at Asia, you, for example, look at something like a panda market or a dim sum market, right? You may have seen recent announcements that a number of non-Chinese issuers are thinking of issuing in renminbi. And of course, the offshore version of that is dim sum in Hong Kong. Those 4 examples are examples of multipolarity, because you are talking about 4 different approaches to markets, issuance, financing, that potentially we wouldn't see to this level a few years ago. Now, in terms of the market pricing, which is what you've asked, markets have not changed their pricing over the last several years to take into account this multipolarity, or as Daleep said, this sort of end of the order that we had since the end of the Cold War. Because you look at all indices, they're all-time highs. I mean, I looked up MSCI Global, year-to-date, up 15%. That represents everyone. But that is true, and of course, you look at things like credit spreads, which are very tight. US investment grade is tighter than 80 basis points, historic lows. But then you also have things that are a little unusual, like you have the gold price up 150% over the last 15, 18 months. You have alternative assets like Bitcoin and others. So there is something that almost doesn't compute with the way equity prices are pretending, and then we can go into that. I think equity prices are so much focused on the potential of incremental growth of AI, almost at the exclusion of everything else. But we can discuss whether this is sustainable or where that will lead us. But it is certainly a different world, even as discussed so far.
And I want to pick up on something that you said. Daleep, please.
Can I jump in on this too? Because maybe we can spice this up a little. I mean, I, for one, as an American citizen, worry deeply about the erosion of institutional norms like the rule of law, due process, checks and balances, professional civil service, independent institutions. But markets are not a morality play. They're not the guardrail that many people are looking for. Markets excel at discounting near-term quantifiable factors like cash flows, cost of capital, compounded growth. Markets are poor at pricing longer-term structural risks that are not easy to measure. So there's a blind spot when it comes to institutional norms that I think is going to characterize the way that markets trade in this environment. They're not going to show up. The erosion of institutional norms is not going to show up on your Bloomberg terminal. It's not going to show up in a GDP print. And I think most examples of a liberal drift show that leaders understand this dynamic, and so they often seek policies to flatter the near-term trajectory by juicing growth, controlling interest rates, sometimes controlling prices. But there are psychological tipping points, right? We've seen them, for example, in Turkey in 2018, that occur particularly when political authorities try to assert control over the central bank. And so that, unsurprisingly,
so you see that as one of the sort of final red lines in the United States, for example?
Yes, but it's not going to be a binary risk. It's not that there's Fed independence or the lack of Fed independence. There's a continuum. We already have jawboning. We already have de facto oversight. The question is, how much further does the White House go? Do we have approval required by the White House for monetary policy decisions? Might there be audits of monetary policy? Might there be a change to the mandate of the Fed? The Fed is governed by the Federal Reserve Act. It's an act of Congress. There's no constitutional protection. It's been amended over 200 times since 1913. So the question is, at what point do markets respond as we go further along that continuum?
And the great Saudi effort has been to try to diversify your economy, right? And that means a lot of export of capital, as you pointed out, and of course trying to also attract within the economy. How do you price those kinds of risks? Because I see a lot of things, for example, investments. For example, I'll use the recent one in the Netherlands, where a Chinese company bought a Dutch chip maker, then the Dutch government took it back, basically, because they were not satisfied that there were national security risks. Is that a concern for you, given how much you've now put capital out into the world in a way in which that could, in an effort to diversify, pose new kinds of risks that we really didn't have a few years ago?
So I'll respond to this, but then I'll comment a little bit on what Daleep said. I think naturally you would have to conduct your risk assessments and understand how you can mitigate these risks. And today we see all over the world that the role of the state in de-risking some of these investments, in understanding kind of and arrangements and agreements with governments is sometimes a tool that needs to be leveraged. There's no shame in calculated, balanced state support or state intervention. Singapore wouldn't be Singapore if it weren't for state intervention. And I agree with Daleep. I think the norm should be open and fair competition, private sector dynamism, et cetera, et cetera. But in some cases, you need to have that intervention. In the cases of de-risking, sometimes the governments can absorb some of these inefficiencies, absorb some of these risks for the private sector to invest. That's not even looking at what would you do for sovereign wealth investments. But on the point that Daleep made, I think one thing to keep in mind is that directions may shift, policies may shift from one administration, one government, from one time to another, but the culture that allows for people to speak up and share their concerns needs to always be protected. I think over the last 15 years, I hate to use Europe as an example in the middle of Europe, but what led to things such as the Corporate Sustainability Due Diligence Directive and the Corporate Sustainability Reporting Directive and its potential impact on the European economy and why so many nation governments are actually commenting on this. We back home are talking to our counterparts here in Europe, in the EU, and some European nations, telling them, some of our companies are talking to us about what they need to do to avoid complying with something that's against international climate agreements and something that goes against sovereignty principles. And we wouldn't be surprised if some of them exit or divest or decide to do some of these decisions. I don't think they want to do that for their shareholders, and they don't want to put governments in a position where sovereignty principles are not, respected. But anyways, what happened over the last 15 years that didn't let certain voices of reason, for me it's the voices of reasons, for others could be just a different voice, have their platform or have their ability to look at science, evidence, and speak up. I think that will help us foresee long-term erosion and long-term risks, similar to what Daleep said, but also at the flip side, listening to these voices could help us make sure that we create long-term economic value from what we're doing. It's no longer just a story of GDP or trade deficits or trade balances. It's long-term economic value creation. We can achieve our GDP targets. We can achieve it in the highest quality. But you don't want to do that without it trickling down to household income, for example.
But you're in a position to do that. For example, you can take a very long-term view. You're not at the behest of a shareholder, say, in some publicly listed American company. So talk a little bit more about how you're managing that long-term vision.
Sure. So, I mean, the first thing was to acknowledge that long-term, there is a risk. There is a path to less resilience, less sustainable growth, the way we were going. So,
and just to make explicit to you, what are the greatest risks?
Obviously, having your economy rely and fluctuate in terms of its activity, depending on a single commodity price, that's one, or depending on how big government budget is. We don't want that. We want private sector dynamism to take a bigger role in terms of our economic activity, and we want the private sector to help the economy export more goods and services in international markets competitively. And we want to do that through stronger links to international markets, signaling open and fair competition, while we have our view on what the state continues to operate in or lead in, such as oil exploration, producing, and others. And also signaling stronger culture for innovation-driven entrepreneurship. That's something that we think long-term is necessary. But these are the risks. Then the ability to plan long-term, but also the ability to deliver long-term is something that has helped us. And today it's the 8th and 9th year of Vision 2030. It still feels like day zero or day one in terms of what do we need to do. No one is getting complacent or over-celebrating. There still needs to be a lot done. And we're talking about what we want to put in the planning horizon for 2040 and 2050 already.
And can I generalize from what His Excellency said? Because I think every country right now is recognizing that the private sector left entirely to itself, it's just not designed to solve the biggest problems, the biggest challenges to economic and national security. In the US, I think both the current administration and the previous one very much wanted to shore up supply chain resilience, sustain technological preeminence, rebuild the industrial base, reboot the defense sector, safeguard energy security. And look, the private sector needs to have its incentives altered through various forms of industrial policy to generate the right outcome. There are different types of industrial policy tools: tax policy, regulation, investment subsidies, equity injections, bridge liquidity, antitrust policy, trade policy, et cetera. But the point is, they each change the composition of economic output in a way that better aligns with the national interest. Now, the key is, how do you avoid ad hoc interventionism? Because if a government is practicing industrial policy in an ad hoc way, it is bound to become a political piggy bank and a national embarrassment. So I think just like we've thought a lot about how do you set out limiting principles for the use of economic weapons, we also need to have a playbook, a framework, a principled framework for how you conduct industrial policy in a way that could be positive sum for the rest of the world. And we can get into that if you'd like.
And I think...
Maybe, please.
Go ahead, go ahead.
Maybe to add on the investor and private sector implications of what His Excellency and Daleep are talking about, I think we've now entered an era where there is no economics alone anymore. It's all political economics. And what I mean by that is when you look at the repercussions of what could be happening in the world, whether it's regulation or various policies, you have to take into account a much more active industrial policy and everything that comes with that. So when you're an investor, whether you're an investor in markets or you're a corporate investor, that has changed.
But so, for example, I don't know that the market's very good at pricing, the U.S. taking equity stakes in companies. Is that something? I mean, how do you assess that? And what are the risks associated with that? Because we've seen a lot of that over the last couple of weeks and months.
I think the market participants are realizing that it's a different environment. But again, as we discussed, equity markets price really one thing, and that is the net present value of the cash flow generation. So we're in a situation where, again, I think because of Gen AI, the potential of productivity gain and revenues is so much, and of course, the fact that there is an anticipation of an easing cycle. Because maybe it could have been a different conversation if the market didn't anticipate that we were going to be easing. Because as you realize, there is limited conversation on inflation. There's a lot of conversation on easing for various reasons. So I think because of that combination, the market is not pricing in it, is not pricing the implications of the change in industrial policy. We've almost accepted it as is. Maybe this is how markets always are. But also, Oliver, what's interesting is things, like nothing changes until the moment it does.
Till the next Solyndra.
Right, so it's not, so I don't think that the fact that, we're not pricing these means anything. It's just how things are, and there will be a moment where it won't be like that.
Sure, but obviously, if something totally unanticipated happens, or a lot of fear takes grip of the market, that has sometimes permanent repercussions for investor confidence and for companies. So balancing that, I think, is a difficult thing to do. But I'd like to come to you on this idea, because we talked a little bit about it just before. What the state is good at doing in terms of directing economic policy, encouraging investment, and what the private sector is better at doing. This is an interplay that you have been at the front and center of, and I'd like to get an idea, since we're seeing it more elsewhere, what your lessons are from it.
So maybe I'll just say that I think state activity, sovereign wealth activity, if the objective is defined and it's transparent how it's shared, I think it's fine. But ultimately, the steady state should be that the state operates in or invests in where the private sector is not, let's say, comfortable, where there's some level of risks, uncertainties, where the government investor can absorb some of these inefficiencies and de-risk, or whether there's a need to move fast. And I think for us, under Vision 2030, there was no tourism sector in the wider sense. Yes, there was religious tourism, and yes, it still exists today, and it's a big component of our tourism sector today, but it didn't exist as in the wider sense. There was no culture sector, entertainment sector, sports sector. And you can't in one day, cold turkey tell people invest in this sector. You had to really demonstrate this sector exists. And we accepted a lot of loss leaders in some of our projects. to signal significantly there's a long-term restructuring of our economy. These sectors exist, and they are not only things that the government are investing in, but they are also attractive for the private sector, and they're creating thousands of jobs for Saudis. So that needed that kind of intervention. But steady state, ultimately, you want your role to recede in that area, to be a financial investor, sometimes a strategic investor with a clear objective, like we did in the past, but the private sector to carry the load. And the private sector's ability to sell goods and services is always better than any. Governments are not designed to sell goods or services. It's mainly the private sector. It can provide the platform, it can provide the e-government, the foundation, but the private sector is more efficient at helping us get to that point where our non-oil export portfolio is attractive. And just to comment on Daleep's point, I think it's very important, and I quote John List. We had a discussion with him, professor at University of Chicago, behavioral science, and he said the number one job of a policymaker is to remove as much as possible from the uncertainty that the private sector faces. So the clearer these guidelines are, and I think we're in a moment of flux where there's repositioning, renegotiation across the board. People want to make sure they don't miss out and no value leakage and position their economies in the right sense and their companies in the right sense for the future. But after that, it needs to be about discipline, boring discipline, guidelines, rules that helps de-risk by removing as much as possible of the uncertainty. And that's when investment actually takes off.
And in the United States, what does that look like? What does the finely threaded, balanced industrial policy in the United States look like?
We can learn a lot from the kingdom in much the way that His Excellency just laid down. Number one, what is the strategic objective of the intervention? Is it supply chain resilience? Is it safeguarding energy security? What's the objective? Two, what's the market failure? Is it a cost differential? Is it a supply bottleneck? Is it a capital constraint? Where's the market failure? Three is, what is the appropriate instrument to remedy the failure? You know, Intel, for example, was a confusing intervention to me because I didn't think they were capital constrained. I think what they lack is customer demand. So match the instrument to the market failure. I think four is, do you actually sustain market competition, or are you creating a single point of failure? You don't want a permanent dependence on the government, as His Excellency was saying. I think five is you want to define what good looks like up front. It shouldn't be a financial gain, it should be a strategic return. And then lastly, what's your exit strategy? How do you sunset public support? How do you sell down public stakes? And I guess there is one more, which is how do you internationalize it? And how do you think about a positive sum framework in which if other countries practice the same kind of industrial policy as the US, are we net better off?
I think this is the fear, though, is a race to the bottom. And I think everybody is trying to figure out how to adopt these policies. The Americans are moving swiftly. China's been moving for a long time. The Europeans are moving slightly more slowly. But this is certainly the risk here, is this race to the bottom on industrial strategy. And, I mean, is that materializing in your mind right now?
There's definitely a lot of redundancy being introduced into the global economy. We are at risk of a subsidy war, no question. But I think here again, the conversation's congealing among countries that are playing by the same rules, which is that we all want to scale up and strengthen our productive capacity in strategic sectors. And we do this in various ways using different kinds of industrial policy. But then here's the important part, is can we give access to each other's productive capacity and our purchasing power for countries that are playing by a similar set of rules? And then what the US is going to ask of its partners is, can we raise barriers against countries not playing by the same rules so that our investments don't get wiped out?
Is anyone playing by the same rules anymore?
No, not right now, but the rate of change, I think, is directionally positive. We're starting to, I mean, I think back to the G7 statement 3 years ago, and there was no mention of economic security, zero. And it's grown exponentially. There is now widespread recognition of the problem. The diagnosis is shared. What we don't yet have is a shared playbook. And that's kind of unsentimental economic realpolitik. Where do our interests overlap, and how can we use our tools to take advantage of that deal space? That's the kind of boring technocratic work that needs to happen now. It's not political.
And I'd like to bring it to the markets, if we could again. Does a more multipolar world need a more multipolar currency market, for example? Does King Dollar's reign, is it sort of guaranteed for the future, or do you see that sort of shifting?
We have seen increased diversification. I mean, I think the most rational explanation of the move in gold prices is that. I think even though, again, the sovereign currencies, the bitcoins, et cetera, of this world are clearly much smaller in terms of holdings, but that shift towards there is certainly in the market. And I think what's happening is we haven't reached that, the rules of the new order as we discussed, but we have to acknowledge the following. I think after the Second World War, with the international institutions that were set up, we enjoyed a long period of peace dividend, because there was an international order and there was a unipolar structure that had certain advantages in terms of, the risks that we had to price in. It's pretty clear that that era is over. What is not clear is what the price implications of the new era will be. Because I think the new era has a lot of uncertainty. Will it go to more of a rule-based structure, meaning there is a concept of economic security, therefore you will have this multipolarity, but there will still be a framework where you could have win-wins. I mean, that's the ideal scenario. But when you look at what's happened so far, that we're not seeing that, right? I mean, we're seeing a bunch of parallel developments, and we're seeing a lot of also choose X or Y, right? That itself, in our opinion, isn't priced in yet. And I think that's where, back to your question of where could a disruption come, it could be something like that. Because when one looks at the price action, one sees that markets are pretending more or less everything is going on as usual. But that's, in real life, we know that that's not the case. But again, let's see when that actually goes into prices. On the currency question that you've asked, again, I think the move in gold is important, but we also have to bear the following fact into mind. When you're looking at a reserve currency, it's not just that you like a system or not, you need liquidity. Because when you're talking about central bank reserves, you need liquidity. And there is only, in my opinion, one alternative to the US dollar, and that's the euro from a liquidity perspective, and even that is not enough. So there is all of this conversation about alternative reserve currencies, but realistically, it's not so clear to me that there is depth in other markets to be able to create a reserve.
And thinking about the example of Saudi Arabia, which has done a very good job, I think, at attracting capital from across the world, investing across the world, do you grow concerned that what we've seen with the tensions, particularly with the United States and China and the kind of blocks emerging there, that position will be harder to maintain, and that there's going to be a sort of forced moment, potentially by the United States, to say, hey, listen, you need to choose one side or the other? How much does that feature in your thinking?
The kingdom is a strong partner of the U.S. and a strong partner of China. The U.S. is our longest, I'd say, business partner for 8-9 decades right now, and China is our largest trading partner right now. And the kingdom will always solve for what's good for its own economic potential, maintaining that these relationships are very important and these partnerships are important for the future. And I think that's something that makes partnering with the kingdom unique. These partnerships are important to be maintained and to be grown for whatever the future may bring. And I think, that's something we've demonstrated now and again. We keep getting this question, but the reality is we're steadfast in terms of having strong partnerships with more countries, with the international community, and trying to address and resolve some of these challenges, global challenges.
And one of the issues that you brought up is the euro as a potential alternative to the dollar, but is obviously not enough. One of the things that has been flagged in this very active discussion politically within Europe is this question about what to do next with these Russian assets and whether or not that could jeopardize the euro as a safe haven. It could jeopardize the European markets. I'll go to you, Daleep, as the sort of architect of a lot of sanction regimes and looking at this question for a very long time. Do you think there's a path for that to happen without endangering the European market?
I do. But you know, we can go very deep on this and very weedy, but let me just step back for a second. I think it's clear that President Putin's objective right now is not peace. His objective is to wipe out the sovereignty of Ukraine. I mean, he's been clear about this since his manifesto in July of 21. And so that's why he's making maximalist demands that he knows no political leader of Ukraine could accept. He's essentially banking on the possibility that the West will fatigue and he can subjugate the country through attrition. The only way to counter a strategy of subjugation through attrition is to demonstrate resolve, financially, militarily, diplomatically. And that's why the Russian assets are so central to Ukraine's survival as a country. Now, we didn't freeze these reserves on February 26th of 2022 as an end to itself. We froze them because they could potentially be a means to an end, to finance, to provide a war chest for Ukraine's defense of its freedom, and to change the calculus of President Putin so that we could eventually broker a just and lasting peace. That was the objective. Now, your question is really about the euro. Our European colleagues have from the start resisted the easiest way of mobilizing the full principal value of the frozen reserves, because they're fearful that maybe confiscation isn't legal, and even if it is legal, it may damage the euro's perception as a safe haven reserve currency asset. So I wrote a paper last year before I went back into the White House to propose what's called a reparation loan. So the frozen assets are loaned to Ukraine in exchange for Russia paying reparations. Ukraine has a legal claim to those reparations. Russia has a legal claim to its frozen assets. If you put both of those claims under one legal roof, you can set them off against each other, and it's not confiscation, because there's still a possibility of the return of the Russian assets. If Russia doesn't pay reparations, it's the author of its own losses. So I am disappointed that we didn't get to yes last night in terms of getting a political signal from the European Council, but I'm optimistic and hopeful that we'll get there by December, because Ukraine still has a financing gap of $60 to $65 billion over the next 2 years. So we live in the land of lousy options. Are you going to increase your fiscal burden? Are you going to allow Ukraine to be unfinanced and lose a war in the heart of Europe and accept the chilling effects and the uncertainties it would unleash? Or are you going to get a return for the risk you've already taken with these frozen reserves? I think the choice is obvious.
And I'd like to come back to that, but I'd like to just stay on Europe for just a moment and go to you on this question of, you know, there was a lot was made of the fact that the United States has become a sort of unreliable partner. A lot of the Europeans were saying this makes, you know, the Buy Europe trade. How real is the Buy Europe trade? Is there a virtue within that, or is it just the consequence of investors wanting to diversify more fully?
There is certainly a strong component of diversification, because when you look at markets that have done very well, of course, the best market has been Hong Kong this year, right? So it's not just Europe. But within Europe, there are a number of themes. I think the change in the German fiscal position is clearly one of them, because it suggests a higher growth. The overall defense and the budgets that have been announced, because again, when you look at the numbers, going to 3.5% to 5% of GDP suggests additional $500 billion of annual spending, which are big amounts. Now, the discussion, of course, is how will they be realized, because there are a number of challenges, or there are a number of metrics that need to be discussed. One is there an opportunity for coordination within Europe? Because we're still seeing a lot of individual states, for very good reasons, acting on their own, but then you really potentially need a more coherent activity, not just for financing purposes, but also for procurement purposes, so that you can have scale. The other one is this Ukraine discussion. This is why the conversation we had on the Ukrainian assets is a very interesting one, because when you look at the defense sector, and when you look at where a lot of the innovation is, it is in Ukraine. right? Because as you know, warfare has shifted. It's no longer probably as much land and naval as it is, cyber and drones and unmanned, etc. So if there is an opportunity to continue to invest in Ukraine in whatever legal means is possible, then not only you're potentially facilitating Ukraine for political reasons, but you're also really significantly investing in the future of defense industry for this continent, which is a must, right? Because it is very related to the whole economic security. So that funding aspect is going to be very important, and we will follow that. But again, maybe there will be some move around that. And again, as His Excellency mentioned, when we talk to both private sector and public sector, our clients don't want to choose. Our clients want and. Our clients want participation, partnership in certain areas with certain geographies and others. So anything that can contribute to that would be very helpful. And also related to technology, which is the most important thing that the market is buying. Of course, when you have bifurcation, you don't advance in technology as much, right? Because you're unable to build on top of the previous one. You have to do parallels. So. Yes, there is interest in Europe, though. I think defense and fiscal and other things, we have to realize that there is a European component to the flows.
Just to put a fine point on it, Oliver, I mean, what's the bigger risk for the euro? Is it to leave Ukraine insufficiently financed to defend itself and to lose the war and unleash all of the chilling effects it would cause in terms of who's next? Or is it to mobilize these assets while respecting the rule of law and maintaining solidarity at a moment when, both for cyclical reasons, because the Fed is about to embark on a fairly aggressive easing campaign, and because of structural concerns, the dollar's had its weakest year on a trade-weighted basis since 1973. I mean, the timing has not been better than right now since this war began for Europe to take this step.
And I'd like to go to Your Excellency from something we saw from the U.S. administration. They put sanctions now on some of the Russian oil majors. And I'm wondering, sort of from the Saudi perspective, what that will mean for you, for your domestic economy. It's obviously bid up the price of oil. It means potentially you are even more of a protagonist on the oil market, given that your barrels will be more eligible than, say, ones that have been cut off.
I mean, we'll have to see longer term than just 2 days impact. For us, for the kingdom, the priority is always solving for long-term market stability, the right supply for the growing demand. We want to make sure that investments are not subject to any risk, that investments continue in a healthy manner that creates the right supply for this demand as it grows. So for us, long-term market stability is important. We're unwinding some of the voluntary cuts that happened in an effort to create that long-term market stability. And here, I think there's a demonstration of the importance of coordination. And I think globally, the world economy and economic stability is not lacking capital. The world is not capital poor, it's coordination poor. It's also institutional capacity poor. We always talk about the financing gap, the funding gap, which is important, I think, on specific cases, important to look at. But when we look at global problems and we keep saying something like the financing gap to achieve X, Y, and Z is this many trillions, in my view, it's a very oversimplified approach, as if saying it's a deficit problem will solve it. It's a huge deficit. The tougher thing, the more difficult thing, is to say, what's driving this, and what do we need to do specifically, and what do we need to do in each of these solution areas? And for the most part, I think we can't just talk about funding gap without talking about the institutional capability gap and what needs to be done to improve institutional capability. There's a lot of idle wealth, institutional and private, around the world that could be directed to better opportunities if there were institutional capabilities in these governments and sometimes in the private enterprises that can help create that more attractive profile.
How do you get there? How do you get the communication to sort of enlist those efforts together in unison?
I mean, it's definitely what I started with. Governments looking at what's important to grow their strength, their economic strength, the ability to develop socially in the right manner, similar to what we're going through. But we're not going through this just by trying to tackle headlines and opportunities and short-term wins. It's a long-term thing we don't talk a lot about, is how the governance and the institutional capability in the Saudi government and the Saudi apparatus has been growing over the last 8 years and continuing to grow. There's institutional debate behind every policy design, and there's impact assessment discussions after policies are announced, and there's openness to hear points of views from everyone. Any citizen who submits an idea to the government, some minister somewhere needs to sit with that person and discuss it. That's to that level.
I'd just like to get a word from you on the sanctions that we saw this week, just because I'd be remiss as the sort of preeminent expert on this, whether you think this changes the calculus, significantly moves the...
All depends on enforcement,
yeah.
And there are two main countries that are importing Russian oil, so the question is whether these sanctions are going to be imposed in a way that's not just a primary sanction, but a secondary sanction. So if you import Russian oil, you can't do business with the US. That will be the test of seriousness. And if it's not enforced in that manner, then this is mostly symbolic.
Okay. And thinking about the defense investment that we've been talking a lot about within Europe, but across the world, do you see a sort of tailwind that could help in other sort of sectors, whether it's innovation? I mean, we've talked a lot about sort of the investments that the U.S. government has made in the past in defense that has led to a lot of breakthroughs. Do you see that as something, and is it easy to price that within the market?
I very much see that. It's this whole concept of dual purpose.
Yeah.
And I think it's driving a lot of the excitement, because when you think of, let's say, defense tech, it's actually deep tech. And given where defense is migrating to, it is a lot of technology, right? Because, and you look at, for example, what Europe has announced a few days ago regarding the defense readiness principles. There are 4 principles: drones, eastern flank, air shield, and space. So very much. And when you look at the investors in this space, I mean, of course, the first thing that's happened is taxonomy has improved. So all of a sudden, it's not a sin investment, if you will, which is very helpful. The second is people are seeing it as a dual purpose, so that when you do it in a military use, you can use it for the civilian. And that's a real tail risk. And maybe adding to His Excellency's point on coordination, which is, of course, very critical, I think there is one aspect which is intelligent regulation and governance, which is what the kingdom is showing. If we were to assume that maybe that may not exist everywhere, right? Because I mean that requires a certain purposefulness, it requires determination, it requires a vision, which I don't think we see in every country. But what does exist is involvement of the private sector. Because again, when the private sector is involved, you find a lot of practical solutions. So it is true that we are going towards a much more assertive industrial policy. But maybe that policy has to be much more targeted, as discussed before. Not this general, but here are the areas that the country needs to invest in for specific strategic goals, and then let the private sector take it. Same thing for defense. Because, for example, in Europe, when we have that conversation, when it's about private companies investing in the future of European defense, it's a much more practical conversation. And the coordination is already happening. Why? Because the reality of economics is you need scale. And if you want scale, you are not going to focus only on one country.
And just sort of final word to you, Your Excellency, just before we take the Q&A from, since we began talking about what 12 months ago looked like, what would you like 12 months from now, in an optimistic case, to seeing kind of the world as it's been evolving, where you'd like things to develop?
Definitely lower uncertainty. And I think going back to a rules-based architecture, even if these rules change a bit, that get us ready for what globalization will evolve into, I think is important. And for us to maybe, for dialogue, of course, to continue, and for these discussions to lead to outcomes, not just announcements and outlays, outcomes that people, that make a difference for people globally. I'll answer your earlier question. Another example of how you go about coordination and institutional capability is something the kingdom has been doing. leveraging multilateral platforms in our efforts to support some countries and some economies and some governments, but also being a voice for reform in these multilateral platforms. Today, the Minister of Finance, Saudi, is the head of the IMFC. At the UN level, with the Sustainable Development Agenda, we're pushing more prioritization, more focus on impact-driven lenses, scalability, and evidence-based initiatives, rather than trying to solve everything all at once and saying it's impossible. And there's back and forth in that discussion. But there is a voice and there is direct support with other governments today is maybe 50% financial and more so tied to reform. We tie our support to the reform that is needed for that support to be meaningful and not to be, not to cause any leakage. And what's beautiful in some cases, the governments that are talking to us are more keen on learning from the institutional capability growth and reform story and the lessons learned that we've had. We've had a lot of successes, but there's things that we didn't get right the first time that we're working on. That's valuable to some of these partners. Making that part of the discussion, you can easily say, okay, it's just a check to be written, but making that part of the conversation consistently and actually living up to your word of saying, I'll support in this capability and that, and we'll have this discussion here or there, I think makes a difference. It changes the culture.
Can we add our...
By all means, let's do it.
Yeah, let's end on a positive.
Yes. We're in the heart of Europe. On our end, the 12-month wish would be, if this talk about deregulation were to stop being talk and become an action.
They don't say deregulation. They say simplification. That would be a good start.
If we were to see an actual implementation of Omnibus, if we were to come back here and say, more of what Mr. Draghi has talked about has happened, because Europe so much needs it, and there is so much of a willingness to do it, and the sense of urgency is there. But it would be wonderful if we came back and said, hey, we actually did this.
For me, it's the emergence of trusted trade corridors or sectoral economic zones. So we have, think about a continuum of economic interdependence. On one end, you have hyperglobalization. That we've learned the hard way leads to the accumulation of dependencies and choke points that can get weaponized. And then you have autarky, which is even worse, because you reduce the economic costs of conflict, therefore making it more likely. You reduce the size of markets, which dulls innovation, and you reduce your resilience to shocks. Sectoral economic zones are somewhere in the middle. And it's a way for us to rebuild the connective tissue in the global economy. So if countries decide, here are 5 supply chains that are critical to our economic growth potential and our national security. We have a high import dependence and limited domestic production capacity. Let me partner with other countries that are playing by the same set of rules, and again, take advantage of each other's productive capacity and purchasing power. I think if you start doing that, industry by industry, ships, cars, drones, batteries, electrolyzers, solar panels, you begin to reconstitute the global economy in a way that can be sustainable.
And just very quickly, on the sort of pendular swing of hyperglobalization to hyper-isolationism, where are we? Are we on the way back down, or are we still going up?
We're going the wrong way. We're drifting towards a transactional form of autarky. Yeah. The law of the jungle. We don't want to go there.
Okay. Well, I failed to end on a positive note, but we'll try nonetheless. Please.
Can I just add, I didn't want to bring this up, but since Elif, I didn't want to bring it up again, but since Elif brought it up on these regulations, I think what's being discussed today in the EU is not something related to one directive that may be reversed or simplified or deregulated. And I agree with you. I noticed that saying deregulation was almost taboo, but it is deregulation, etc. It's not something that is an opportunity if it passes. So I think this is going to be a test for Europe's seriousness about becoming more competitive. I care about this because it can hinder our direction to have a stronger economic partnership with many European countries, if not all the EU. And I care about this because the private sector has reached out to us and said, if this doesn't change, this may hurt our business, this may hurt, may push us to exit, may push us to divest. And we don't want to see that. As a government, we don't want to see that. But of course, we don't want to see anyone complying with things that go against sovereignty principles. So I think it is a test. It's not something, if it passes, it doesn't, we'll deal with the next one. This is the test that I think that's in front of Europe today, specifically the CS 3D, or some people call it CS triple D, and I learned from my friends and colleagues that some people in Germany call it CS trouble D. So I think if that is going to be either categorically abolished or deregulated to the point where the concerns go away, I think it will send the right kind of signal that shows what Dr. Draghi recently called for, more urgency in terms of embracing competitiveness, and it can bring back knowledge and bring back competitiveness to some sectors beyond even the auto sector in Germany, as an example. We were talking about this last night. I think because of the investments in defense and defense technology, there's room for these two pillars of R&D and innovation to trickle down to other sectors that can make Europe a little more competitive than what it traditionally was.
Well, we hope your call is heard in Brussels. There are a number of commissioners in the building right now, so perhaps they are hearing it as we speak. So I'll just leave the last few minutes here for Q&A from the audience. I'm not sure where the microphone is. I guess you can raise your hand, and then, yeah, we'll bring you a microphone. And if you could just direct your question to someone in specific.
Thank you. I'm Aminata Touré, former Prime Minister of Senegal and current High Representative of President Faye of Senegal. So let me bring the voice of another corner of the world that is obviously not present there, and that represent 1.4 billion people and an economy of 3.4 trillion. So I guess if you're talking about global economy, it would be good to talk about it. And the 55 African countries are going toward the free trade Africa zone with a potential by 2050 of a market of $30 to $50 trillion. So I guess Africa is going to be the next frontier, I guess, of the world economy. And some of the partners do understand that very well. China included, and also Saudi and other part of the world. So I would call upon Europe maybe to wear different glasses and have a larger view of what's going on. Since we're talking about financing and security, economic security, let me raise two issues. The first one, which is related to tax fairness. That we don't have, we don't see yet, and you do have the UN framework on collaboration on international tax, and I'm very pleased to see that OECD is moving forward to at least advocating for a 15% tax to be paid in countries where wealth is created and exported, which is not the case yet, but we have to take that into consideration. Definitely. So I would like to know, all of you, what do you think about that? Because all Western countries are dragging their feet when it comes to paying taxes in the countries where the wealth is created. For instance, if you take DRC, the Democratic Republic of the Congo, reports shows that the untapped reserve of what the potential would be when it comes to minerals is estimated to 24 trillion. So imagine when part of that tax would be paid in countries, how it would impact on living standards, which is not the case yet. So I like to also ask your point about interest rates of money being borrowed on your market, most of, it's a European and American market, with a rate that is 4 times higher for Africa, with this very famous, Africa risk premium that have no base, as demonstrated by many researchers, including Standard & Poor's, where we do pay for no reason, because none of our countries defaulted on our credits most of the time. So this is also points that needs to be taken into consideration when we talk about those issues, and unfortunately, I don't see that happening on that table. So I would like to have very much your views on how to correct what we consider as African as an utterly discriminatory system when it comes to the issue of international financing. Thank you.
Maybe I can have a few comments. First of all, it's very productive to have an economic union within Africa, because Africa does have a lot of potential, as you've outlined. I think the opportunity for us is, we've identified Africa as the market, the frontier market for a very long time, but it is still there, right? So how do we lift it? In terms of cost of financing, which is a very important point and which underlines a lot of things, I think it comes back to some of what we've discussed. If we care about economic security, we should be able to look at public-private partnerships when it comes to projects like those in Africa. Because for what they're worth, market is giving a certain pricing for cost of borrowing. We could argue it's fair, unfair, probably there are issues with it, but that's the market price. But if that's too high, which of course is the case, can we have that state partnership, whether it's in terms of export finance guarantee, sovereign guarantee, and others? And again, during this forum here, we discussed this a lot, because there aren't enough of those tools where the public sector, through MDBs and other institutions, can create that sovereign guarantee so that it becomes financeable. That's a big deal. That's a big deal for Africa. It's a big deal also for any kind of defense and other financings. But that again requires coordination. It requires institutions having that mindset. But I think it would be very favorable for the world.
Your Excellency?
I think I'll have to understand better what the questions were referring to in terms of the details. I don't disagree with Elif, but for me to answer properly. But I'll tell you that there are great examples. And I know we talked about this, Elif, before. We don't want to talk about Africa as one thing. It's, as you said, more than 50 nations. And there are great examples of coordination, great examples of institutional capability that's built, that has made some nations, even smaller in terms of size and resources, more impactful towards their own objectives. I think that needs to continue. For the Kingdom, the relationship with Africa is shifting from some trade, from security and political coordination, from foreign aid assistance to larger trade profiles, more investment, co-investment opportunities, more discussions on policy and technical issues that can help us and our African counterparts learn from our own experiences and grow institutional capabilities. And it's been a priority since the start of Vision 2030.
And I also want to take a question from the Young Voices program as well, from Hunter Davies from HEC Paris, who I believe is seated over there.
Hello. Hi. My name is Hunter Davies. I'm from HEC Paris. But our question for you is, advanced economies are struggling to reconcile rising fiscal pressures from aging populations with the need to sustain growth and competitiveness. From your perspective, since this is for the table, whether through policy design, capital markets, or strategic investment, what models or partnerships could help address this structural challenge?
I think it's a great question, and the premise is correct. Long-term growth is all about how many people are working in your society and how productive are they. We know in terms of the labor force, it's trending the wrong way in most advanced economies. Fertility rates are plummeting well below the replacement rate, and immigration policies are becoming far more restrictive, in my view, regrettably. And so the real question is, can you get productive? And what can governments do? I actually think there's a role. I mean, to me, there's a market failure in our venture community, the most dynamic in the world, to invest in projects that take a long time horizon, let's say more than a decade, to generate a commercially attractive return, that involve a lot of risk, geopolitical or regulatory risk, and that require a lot of upfront capital. Most venture investors have better alternatives than these deep tech investments that I'm referencing. They can invest in software or apps that scale very quickly and you can exit in 3 to 5 years. So I think there's a role for sovereign vehicles to play a catalytic role in moonshot technologies like AI, quantum, synthetic biology, fusion, but also old economy sectors like shipbuilding or lagging edge semiconductors or mining. And that type of combination, I think could play a catalytic role to unleash the private sector and really drive productivity levels in ways that sustain our growth pace.
So maybe to comment on, I think I agree 100%, especially for aging economies. I think that's approach. One thing I heard from actually Larry Fink talk about in terms of Japan being an already aging society. Because of that challenge, that means that there is a potential for Japan, its tech sector, its government, its institutional capabilities to really leverage artificial intelligence towards improving productivity. And they're cutting edge in terms of manufacturing, and that can be something to look at. But even younger nations, younger economies, such as Saudi, it's important to preempt. We're a young population, 71% below the age of 35. But we calculated that in 19 years, we'll start the aging process. Today, 4% are above the age of 65, and they consume 70% of our health bill. If that 4% becomes the 14 or the 22% by 2045, 2050, without a change in how it consumes the health bill, how healthy people are, how athletic they are, how productive they are, it'll be a huge fiscal challenge for the kingdom. And that's why we're investing in technology and reforms and human capital development initiatives, looking at population policy, population growth strategies, and many others, but also things like artificial intelligence. We're very serious about building institutional capabilities around artificial intelligence in the public sector and the private sector, because I think the most important thing to do with this potential change, technological change, is to be a power user. And that can help you become more productive.
Well, thank you very much, all of you, for joining the panel. I'd like you to invite everybody to thank our panel today in our last few seconds here. Thank you very much.
Yeah, thank you. Thank you.
And just thank you, guys.
Thank you.